Happy New Year, everyone. I hope you all enjoyed the holidays and are ready to kick off 2025 with, well, a deep dive into the financial news that shaped the last week of 2024 and the very first few days of 2025. We've got a stack of articles here covering everything from stocks and bonds to commodities, the whole shebang. And trust me, some of these stories are pretty wild.
It is a lot to take in, especially after a week of holiday distraction. But we'll break it down for you and help you figure out what really matters.
Exactly. Think of us as your financial detox gurus, helping you sift through the noise and find the signal. And speaking of noise, did you see what happened to cocoa prices? They practically doubled last year. Imagine paying twice as much for your favorite chocolate bar. Yikes.
It's true. Cocoa prices went absolutely bananas in 2024, and we'll get into the reasons for that later. But first, let's zoom out and look at the bigger economic picture.
Okay, let's set the stage.
Yeah.
What were the major forces at play as we closed out 2024 and rang in the new year?
Well, the Fed cut interest rates, which is usually good news for the markets. But then they hinted they might slow down those cuts in 2025, which threw some cold water on things. Inflation is proving to be more stubborn than expected, and everyone's trying to figure out what a Trump presidency actually means for the economy.
So basically a lot of uncertainty swirling around. It sounds like we've got a real puzzle on our hands.
Exactly. And to solve this puzzle, we need to look at how each piece of the market is reacting to this uncertain backdrop. So let's start with stocks.
Okay, stocks. Last year was all about those magnificent 7 tech giants. NVIDIA, Tesla, Apple, Microsoft. You know the ones. And the S&P 500 gained a whopping 23%, its best 2-year run in decades. It seems like the AI boom was the driving force behind this incredible rally.
Absolutely. The AI boom is the real deal. But here's where it gets interesting. Some analysts are saying the easy money phase of this boom is over.
So just buying any AI-related stock isn't going to cut it anymore.
Exactly. Now it's about figuring out which companies can actually turn all this AI hype into profits. It's about looking beyond the chip makers and focusing on the companies that are using AI to solve real-world problems and create value for their customers. Think software and services, companies like Apple Salesforce, even smaller players like Yext and Box.
That makes sense. It's not just about who's building the AI chips. It's about who's actually using AI to make a difference, to generate revenue, and to change the way we live and work.
Precisely. But while the tech giants continue to grab headlines, there's another corner of the stock market that's worth watching. Small and mid-cap stocks.
Right. I read somewhere that these smaller companies could be poised for a comeback under Trump. Is that because of his policies on interest rates and deregulation?
That's the theory. Lower interest rates and a lighter regulatory touch could create a more favorable environment for smaller businesses to grow and thrive. But, and this is a big but, there's also concern that some of Trump's other policies like tariffs could actually fuel inflation and end up hurting those same businesses.
So it's a bit of a double-edged sword. Potential opportunity, but with some risks attached.
Exactly. It's a gamble, and it really depends on how Trump's policies play out in the real world. It's definitely something for investors to watch closely in 2025. What do you think? Would you bet on these smaller companies right now, or is it too risky given all the uncertainty?
That's a tough one. It's tempting to chase those potential gains, but the risk of inflation is definitely a concern. I'm going to need to mull this one over with a cup of coffee.
Yeah.
And speaking of coffee, wasn't there some crazy stuff happening with coffee and other commodities last year? Like, didn't those prices go haywire?
You're right. Commodities were all over the map in 2024, driven by a mix of factors, including those unpredictable climate shocks we talked about earlier.
Oh, right. That's where those skyrocketing cocoa prices come in. It was all over the news.
Yeah.
Double the price of chocolate, people freaking out about their holiday baking. What exactly happened there?
Well, the simple answer is bad weather. West Africa, which supplies about 70% of the world's cocoa, was hit hard by drought. And these powerful dry winds called the harmattan, it decimated the crop, sending prices soaring.
Wow. So it was a perfect storm of climate woes. And it wasn't just cocoa, right? I remember reading about coffee prices hitting record highs, too.
You're absolutely right. Brazil, the world's largest coffee producer, was hit by a severe drought, which sent coffee prices through the roof. And it's making investors nervous about agricultural commodities in general.
So our morning cup of joe is getting a lot more expensive. And it's all thanks to Mother Nature throwing a tantrum. This is getting depressing. Are there any bright spots in the commodities market?
Well, if you're a gold bug, you probably had a pretty good year. Gold prices surged over 30% in 2024.
Now that's what I'm talking about. Sparkle and shine, baby. But why was gold so hot? Is it because everyone's worried about the economy and looking for a safe haven?
That's a big part of it. Central banks around the world are buying up gold like crazy. likely as a hedge against all the geopolitical uncertainty, the war, the tensions, you name it. Gold is seen as a safe haven asset that tends to hold its value during times of turmoil.
Makes sense. So gold glittered coffee got pricey and cocoa went bonkers. What about the other big commodity? Oil. How did that fare in 2024?
Oil had a bit of a roller coaster year, lots of ups and downs, but ultimately not much change. Prices ended up hovering around $72 to $73 a barrel.
So not as dramatic as those cocoa beans, huh?
Not quite, but even in a relatively quiet year for oil, there's always a lot going on behind the scenes. For example, OPEC, plus the group of major oil-producing countries, continued to cut production to try and stabilize prices. And at the same time, weaker demand from China, which is usually a huge consumer of oil, put downward pressure on the market.
It's like a constant tug-of-war between supply and demand, with all these geopolitical factors thrown into the mix.
Exactly, and that's what makes the commodities market so fascinating and so volatile.
Okay, so we've covered stocks. The Magnificent Seven still shining, but maybe some opportunities emerging with smaller companies. And commodities.
Yeah.
Gold glittering coffee, getting pricey cocoa going bonkers, and oil holding steady. But what about bonds? Did they get caught up in all this excitement too?
Bonds definitely had their own share of drama in 2024. In fact, bond yields went up, which might seem counterintuitive since the Fed was cutting interest rates.
Wait, I'm confused. If the Fed cuts rates, shouldn't bond yields go down?
It does seem counterintuitive,
Yeah.
but it all comes down to investor expectations. When the Fed hinted that they might slow down those rate cuts in 2025, investors started to worry about inflation. And when inflation fears rise, bond yields tend to go up.
Okay, so higher yields mean lower bond prices, right? That doesn't sound like a great year for bondholders.
Not necessarily. Remember those junk bonds we talked about earlier?
Yeah.
The ones considered riskier because they're issued by companies with lower credit ratings?
Yeah, those. I thought they were supposed to be well junk.
Well, they defied expectations and actually performed quite well last year. ETFs like HYG and JNK, which track junk bonds, had returns of over 8%. And that's because corporate balance sheets are surprisingly strong right now. And the economy didn't completely tank, as some had feared.
So even though junk bonds are considered riskier, they actually did better than some of those supposedly safer investments. That's surprising.
It is, but it points to a bigger trend that's been gaining momentum: the rise of private credit.
Private credit. What exactly is that?
It's a way for institutional investors to lend money directly to companies, bypassing the traditional bond market. Think of it as a more sophisticated, less regulated way of investing in debt.
Sounds a bit risky. Why would anyone choose to invest in private credit instead of sticking with those good old-fashioned bonds?
Well, as interest rates stay low and investors are hungry for higher returns, they're becoming more comfortable with these less traditional investments.
So private credit junk bonds doing surprisingly well. It sounds like the world of fixed income is getting pretty wild too.
It certainly is, and that's just a taste of what we'll be exploring in the rest of this deep dive.
Stay tuned, folks, because in part 2, we're going to tackle the big question. What does all this mean for you? How can you make sense of this whirlwind of financial news and actually use it to make smarter decisions in 2025? We'll be right back.
Welcome back to our deep dive into the first week of 2025's financial news.
We've covered a lot of ground already. Stocks, bonds, commodities, and wow, my head is spinning. I need a financial GPS to navigate all this.
I hear you. It's a lot to process, but that's exactly why we're here, to help you distill it down to what really matters for you, our listeners.
Okay, so let's get practical. What does all this news actually mean for the average investor trying to navigate the year ahead?
Well, the first takeaway is pretty straightforward. 2025 is shaping up to be a volatile year, and you need to be prepared for the ride.
Oh, I was afraid you were going to say that. So batten down the hatches and brace for impact.
More like adjust your sails and be ready to change course quickly. Flexibility is key in a volatile market. But don't let the uncertainty paralyze you. Remember, every market shift creates opportunities. It's just about being informed and knowing where to look.
Okay, I like that. Turning uncertainty into opportunity. So where should we be looking? Give us some specific areas to watch in 2025.
Well, let's start with the tech sector. Those Magnificent Seven stocks might not have as smooth a ride in 2025 as they did in 2024, but the underlying trend of artificial intelligence is here to stay. The key is to look beyond the hype and focus on companies that are actually generating revenue from AI, not just talking about it.
So less about the chips and more about the software and services that are actually using AI to solve real-world problems.
Exactly. Companies that are using AI to create value for their customers. That's where the sustainable growth is. Think about healthcare finance, even retail. AI is transforming every industry, and the companies that are leading this transformation are the ones to watch.
Makes sense. So I'm looking for tech investments. I should be thinking about who's actually making money from AI, not just who's making the most noise.
Precisely. And don't overlook those smaller, more nimble tech companies. They might be better positioned to capitalize on niche opportunities within the AI landscape.
Okay, that's tech. What about the rest of the market? Are small and mid-cap stocks still a potential bet under Trump, despite those inflation worries we talked about earlier?
That's a tough one. There's definitely potential there, especially if Trump follows through on his promises of deregulation and tax cuts. But those same policies could also trigger inflation, which would hurt smaller companies the most.
So it's a gamble. Maybe one for the more risk-tolerant investors out there.
Exactly. If you're considering dipping your toes into small and mid-cap stocks, be prepared for some volatility and do your research. Look for companies with solid fundamentals, strong earnings, low debt, and a clear path to growth.
That sounds like good advice for any investment, really. Okay, so we've got tech and maybe small caps, depending on your risk appetite. What else should we be watching in 2025?
Well, those climate shocks we talked about aren't going away anytime soon. They're going to continue to impact commodity prices, especially in the agricultural sector.
Right. We saw that with cocoa and coffee prices going through the roof last year. So maybe it's time to stock up on chocolate and coffee while we can still afford them.
Huh. That's one way to look at it. But seriously, climate change is creating both risks and opportunities in the commodities market. We're already seeing it with cocoa and coffee, but it could extend to other crops as well.
So should we be investing in farmland or something?
It's an option, but a complex one. There are more accessible ways to play the climate trend, like investing in companies that are developing drought-resistant crops or improving agricultural efficiency.
Okay, so keep an eye on those climate-resilient companies. And what about gold? It had a stellar year, but is it still a good bet in 2025?
Gold is always a bit of a wild card. It tends to do well during times of uncertainty, but it can also be very volatile. If those geopolitical tensions ease or the Fed surprises us with a more aggressive rate hike plan, gold could take a hit.
So a good hedge against uncertainty, but not a guaranteed winner.
Exactly. If you're considering gold, think of it as insurance for your portfolio, not a core investment.
Got it. So we've covered tech, small caps, commodities, and gold. What about bonds? Are they still a safe haven in this crazy market?
Well, the days of bonds being a boring, predictable investment are long gone. We're seeing more volatility in the bond market than ever before, and that's likely to continue in 2025.
So maybe those bond vigilantes are back in town. Those investors who sell off bonds when they think the government is being fiscally irresponsible.
Perhaps. With all the uncertainty around Trump's policies, they might be getting ready to make some noise. Remember when those vigilantes sell bonds, it drives up yields, which can send ripples through the entire market.
Sounds like we need to keep a close eye on those bond yields. So what's the bottom line for bond investors in 2025?
Diversification is key. Don't put all your eggs in one basket. Consider a mix of different types of bonds. Short-term, long-term, government, corporate, even those high-yield junk bonds if you're feeling adventurous.
And maybe a dash of gold, just for good measure.
Couldn't hurt. But the most important thing is to stay informed. Keep up with the news, do your research, and don't be afraid to adjust your portfolio as the market changes.
Solid advice. Okay, so we've talked about where to look for opportunities in 2025. But what about the bigger picture? What are the key themes we should be paying attention to?
One thing that keeps coming up is the tension between growth and inflation.
Right, the Fed wants to keep the economy humming, but they also don't want prices to spiral out of control. It's a delicate balancing act.
Exactly. And Trump's policies are adding another layer of complexity. His tax cuts and spending plans could boost growth in the short term, but they could also lead to higher inflation down the road.
So we're all just waiting to see how this plays out, with the Fed trying to walk this tightrope between growth and inflation.
In a sense, yes. It's hard to predict which way it will tip.
And what about those global risks we talked about earlier? The war, the geopolitical tensions. Are those going to keep weighing on the market?
It's hard to say for sure, but geopolitical uncertainty is definitely a factor that investors need to keep in mind. It can lead to volatility in the markets, especially in commodities like oil, which is so sensitive to global events.
So we need to be prepared for anything. Sounds like a lot to keep track of.
It is. But remember, you don't have to be an expert to make smart financial decisions. Just stay informed, do your research, and don't be afraid to seek out professional advice if you need it.
Great advice. Okay, so we've covered a lot of ground in this deep dive,
Yeah.
from the nitty-gritty of specific investments to the broader themes shaping the market. But before we wrap up part two, I want to touch on one more thing: mindset. It's easy to get caught up in the fear and uncertainty when the market is volatile. But how can we approach 2025 with a healthier mindset?
I love that you're bringing this up. Mindset is crucial, especially in a year like this, which is likely to be full of surprises. Instead of fearing volatility, try to see it as a source of opportunity. Remember, every market shift creates winners and losers.
So instead of getting swept up in the fear,
Hmm.
we should be looking for those opportunities that emerge from the chaos.
Exactly. If cocoa prices go up, maybe it's a chance to discover a new favorite chocolate brand or explore the world of fair trade coffee. If tech stocks take a dip, maybe it's an opportunity to invest in those smaller, innovative companies that are flying under the radar.
I like that. Turning lemons into lemonade. Or maybe cocoa beans into gourmet chocolate.
Precisely. And if bond yields spike, maybe it's a good time to reevaluate your fixed income strategy and consider some alternative investments.
The point is, don't let fear paralyze you. Stay informed, be adaptable, and remember that every challenge is also a chance to learn and grow. We can actually use this volatility to our advantage.
I couldn't have said it better myself. Well said.
So as we head into this new year, let's ditch the resolutions and embrace a new investment mantra. Be curious, be flexible, and be ready to seize those opportunities.
I love it. That's a resolution I can get behind.
Great. Well, I think we've covered just about everything for today, but don't worry, we're not done yet. In part three of this deep dive, we're going to take a closer look at something we've only touched on briefly so far: the world of private credit. It's an area that's attracting more and more investor attention, and we're going to break down what you need to know to navigate this exciting but potentially risky corner of the market. Stay tuned. Welcome back to the final part of our deep dive into the financial landscape of 2025.
We've covered a lot of ground already. From those high-flying tech stocks to the cocoa craze that's shaking up the commodity market.
But now, it's time to venture into a slightly more mysterious corner of the financial world: private credit.
Oh, yes. The realm of direct lending and shadow banking.
It does sound a bit intimidating, doesn't it? Like something out of a spy novel.
It does have a certain mystique to it, but it's not as complicated as it might seem. At its core, private credit is simply about lending money to companies outside of the traditional banking system.
So instead of buying bonds issued by a company, you're essentially giving them a loan directly.
Exactly. And instead of going through a bank, these loans are typically arranged by private equity firms, hedge funds, or other institutional investors.
I see. So why are people so interested in private credit? Is it just about chasing higher returns?
Well, that's certainly part of the appeal. Private credit deals often offer higher interest rates than traditional corporate bonds, especially in today's low-yield environment.
That makes sense. But higher returns usually come with higher risks, right?
You're absolutely right. Private credit is not for the faint of heart. These loans are often made to companies that are considered riskier, like those with high debt levels or those operating in volatile industries.
So it's a bit like those junk bonds we talked about earlier, but even riskier.
In some ways, yes, but there's also a key difference. Private credit deals are typically structured with more protections for the lender, like stricter covenants and collateral requirements.
So if the borrower defaults, the lender has a better chance of recovering their money.
Exactly. That's why private credit is often seen as a way to get higher returns without taking on as much risk as investing in public junk bonds.
Okay, that makes sense. But if private credit offers higher returns with less risk than junk bonds, why isn't everyone doing it?
Well, there are a few reasons. First, private credit deals are typically much larger than public bond offerings, so they're not accessible to individual investors.
So it's more of an institutional investor game.
For the most part, yes. You need deep pockets to play in this space.
Okay, that makes sense. What else is holding people back?
Well, private credit is also less liquid than public bonds. You can't just sell your investment on the stock market whenever you want. You're typically locked in for a longer period of time.
So the less flexible investment.
Precisely. And that lack of liquidity can make it difficult to exit a position if you need to raise cash quickly.
I see. So private credit is higher return, potentially lower risk than junk bonds, but also less accessible and less liquid.
Exactly. It's a trade-off like any investment. But here's the thing. Private credit is becoming more and more mainstream.
Really? Why is that?
Well, for one thing, the low-yield environment's pushing investors to look for alternatives. They're hungry for yield, and private credit can offer that.
Makes sense. But there must be more to it than that.
There is. Another factor is the growth of the private equity industry. Private equity firms are sitting on mountains of cash, and they're increasingly using private credit to finance their deals.
So it's becoming a bigger part of the financial ecosystem.
Absolutely. And that's attracting more attention from institutional investors who are seeing the potential for diversification and attractive returns.
Okay, so private credit is growing, it offers potential benefits, but it's also not without its risks. What's the bottom line for listeners who are curious about this corner of the market?
Well, the first thing is to do your research. Private credit is a complex area, and it's important to understand the risks involved before you invest.
So not something to jump into blindly.
Definitely not. If you're considering private credit, talk to a financial advisor who specializes in this area. They can help you assess the risks and opportunities and determine if it's a good fit for your portfolio.
Solid advice. And what about those listeners who are already invested in private credit? Any tips for navigating this potentially turbulent year?
Well, as with any investment, diversification is key. Don't put all your eggs in one basket. Spread your private credit investments across different industries, geographies, and even types of loans.
So a well-rounded portfolio,
Yeah.
just like with stocks and bonds.
Exactly. And as always, stay informed, keep up with the news, and monitor the performance of your investments. If you see any red flags, don't be afraid to reevaluate your position.
Great advice. Okay, so we've demystified private credit, explored its potential benefits and risks, and even offered some tips for navigating this increasingly popular investment strategy. I feel like we've given our listeners a lot to think about today.
We have. It's been a whirlwind tour of the financial landscape. But hopefully our listeners are now feeling a bit more informed and a lot less intimidated by the year ahead.
I think you're right. We've covered a lot of ground, from the soaring heights of the tech sector to the unpredictable swings of the commodity markets, and even the shadowy world of private credit.
And remember, knowledge is power. The more you understand about the markets, the better equipped you'll be to make smart decisions and achieve your financial goals.
Absolutely. So as we head into this new year, let's raise a glass to continued learning savvy investing, and of course, a healthy dose of curiosity.
Cheers to that.
And thank you for joining us on this deep dive into the financial forces shaping 2025. We'll see you next time for another deep dive into a topic that's impacting your world.